Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
You are listening to Get Rich Education, show number 10. Thanks for being here. Your host's name is Keith Weinhold. That's me. A typical Get Rich Education episode is going to provide you with 5 to 10 times more value than the time that you invested here. I will consistently bring you information that you don't hear anywhere else. If you heard this material somewhere else, then there would be no need for you to be here. Today is a fundamental episode. We're going to go over what some basic investor vocabulary terms mean. You know, some investing shows or show hosts can talk over your head. Whether they're trying to do it or not, they use sophisticated terms that just get the listener lost. I know it confused me when I was starting out investing more than 12 years ago. The listener might hang in there and use context clues to connect the dots, but they really never get the full picture and they don't get the value out of the content that they otherwise would have. So today we're in a very unassuming mode and we're going to slow it down and make sure that you have a better understanding of these terms before we move on. So really, congratulations. Just the fact that you're listening to my voice right now shows me that you are the type of person that knows that there are better and higher uses of your time than checking your Facebook feed for the third time in 20 minutes or watching your team's 29th regular season NBA game when half of the teams end up making the playoffs anyway. This week I'm doing the show from here inside a conference room at the hotel where my wife and I are staying here in Los Angeles. We were at the Hollywood Walk of Fame today. We went to the La Brea Tar Pits. Didn't fall into the tar pits, luckily. While visiting Southern California this week, I actually have managed to not look at any investment real estate. But yesterday I was in Las Vegas and met with the owner of a gold and silver investment company to lay the foundation for a future show episode that I will likely do with you here at GRE. This is an investing show, so often you're going to want to ask yourself, what's my return on investment? And you should. But even before that, keep asking yourself, what's my return on time? Focus on enhancing the quality of your life's time. The things that you do to ensure that you have a better quality of life can never be taken away from you. Once time is lost, it cannot be replenished. I've been increasing my quality of time these past few days. If you regularly ask, what's my return on time? You will just naturally migrate to better and higher uses in your life, and you're going to find the right relationships with the right people sooner. Meanwhile, you have a proficient team that does more of your work for you, and you're going to live a more fulfilling life. Well, one way that you can make a more effective use of your and others' time is to have an effective investor vocabulary yourself. Vocabulary is like a fertilizer that will help your opportunities grow. That will help you repel insects and attract the right people. As we've said before, you are the average of the 5 people that you spend the most time with. Your interests will be the average of their 5 interests. Your income will be the average of their 5 incomes. And likewise, your thoughts and vocabulary will be the average of their 5 thoughts and vocabularies. So, as to not leave listeners behind, let's circle back and regroup on what some common investor vocabulary terms actually mean. So we're dropping a little vocab rehab on you here. Some investor information sources zoom ahead and provide content like everyone knows what some of these investor terms are. Now, they seem like everyday terms among the people that I associate with, but I know that some of these words were foreign to me when I first heard them. So besides just first giving you the textbook definition of these terms, I'm going to use a number of them in an example, tell you why you should even care, and even give you a suggestion as to how you might use these terms in a coherent sentence. As you interact with other people, you sell yourself every day in some capacity, and the words that you use shape people's impressions of you. They enable you to network more effectively with others, fit in with groups that probably have better ideas of how to structure investment deals and propel your investor life forward. So if you want to make money work hard for you and make other people's money work hard for you too, you need to know these terms well. And luckily, it's fun to actually practice these. We'll start generally alphabetically, and we're just going to hit a few key terms as I like to keep my podcast more brief and moving along. So the first term, arbitrage, Arbitrage. Arbitrage is just kind of a cool sounding word, and it's an integral investor word. Defined, it's the simultaneous buying and selling of securities, currency, or commodities in different markets to take advantage of differing prices for the same asset. The common use of arbitrage in investorese seems to tweak this hard definition. For example, if you borrow money from a bank at 5% and you invest it in an oil and gas limited partnership that yields a 9% return for you, the difference is your arbitrage, 4%. The money you're making in the investment exceeds the rate that you borrowed at. You've got to invest at a higher rate than what you borrow the money for to create arbitrage, or else you lose. If you pull money off a credit card at one of those 0% APR for 12 months with a 3% balance transfer fee deals, your cost of money for those 12 months is 3%. If you invest in a stock that gains 11%, your arbitrage is 11 minus 3, or 8%. Used in a cool sounding sentence, now you can say that you just used a low interest rate bank loan to create arbitrage in an income property. That makes you sound smart. Everyday people just aren't using that word. There was a Richard Gere movie called Arbitrage that came out a couple years ago. So that word got a little bit more common use, but really not so much. You might ask, where's the best arbitrage in the investor world today? I mean, that's a sentence that you might use. Just a mere mention of that word can make you appear next level to others. Arbitrage is simple to understand, but you drop that word in your workplace or at a party and people might nod their heads like they know what you mean, but then they're saying, they got to go to the restroom so they can go look up the word on their phone just to try to get on the same page with you. So that's arbitrage. The next term is cash flow. That's 2 words. It's defined as the movement of money into or out of a business or property. Some investors will tell you that it all comes down to cash flow. Personally, cash flow is the number one reason that I invest in real estate. Cash flow is how, what I like to say, you make money follow you, which is a central tenet at GRE. You should only buy a property where the monthly rent income exceeds the monthly expenses. That creates cash flow in your life. All right, so what does that really mean? Take your monthly income from a rental property. That is mostly or fully rent income. You might have some extra income from a laundry room or additional tenant storage units on the property, but for monthly income, we're basically talking about rent income. We'll call that property's income $2,000. Well, you need to subtract all the monthly property expenses from that $2,000, and what's left over is your cash flow. What expenses do you deduct from that $2,000 rent income? Well, most people remember that you deduct the monthly mortgage payment, but the other common expenses in addition to the mortgage can best be summarized with the acronym VIMTM. VIMTM. VIMTM is vacancy, insurance, maintenance, taxes, and management. And there might be a utility payment too, depending on the type of property that you buy. But VIMTM, in addition to the mortgage, are the chief recurring main expenses. Well, if the income is $2,000, deduct out a mortgage of, say, $1,000, and all the other VIMTM expenses mentioned are another $600 taken away. Well, then you've got $400 left over. Well, that's your cash flow, and that money goes to you each month. That's money you don't have to work for. Notice that your management was already paid out of that as the last M in VIMTM. That's making money follow you. So you're getting paid well with this cash flow every month while you're holding the asset that often goes up in value. So used in a sentence, you might say, I only buy properties that cash flow. And to me, that's the only way to buy, and I only suggest that you buy that way. The next term is cash-on-cash return. Cash-on-cash return is defined as cash income on a cash investment. All right, so from the last example in cash flow, let's take that $400 monthly cash flow, multiply it by 12 to get $4,800 of annual cash flow. That $4,800 of annual cash flow, well, say we put $48,000 into the building on down payment and closing costs to control this small apartment building that generates cash flow. Well, we divide our cash income, that cash flow of $4,800 per year, by the cash invested, $48,000, to get a cash-on-cash return of 10%. Cash-on-cash return usually refers to real estate, but it can refer to your stock returns too, especially if that stock pays a dividend. When a real estate investor uses the term ROI, or return on investment, they're usually referring to cash-on-cash return, though there are some minor differences between those terms, okay? But cash-on-cash return, that has nothing to do with equity growth, which is like the value of the building going from $200,000 up to $210K in a year. That's equity growth. That's separate from cash-on-cash return. Cash-on-cash return can be abbreviated as CCR. That's how I usually abbreviate it, but I also commonly see COC, or some even abbreviate cash-on-cash return as COCR. So they all mean the same thing. All right, the next term is capitalization rate. Most people just call it cap rate. Defined, it's a valuation measure to compare different real estate investments. It's the ratio between the net operating income of a property and that property's value or purchase price. So it's net operating income divided by value or purchase price. Net operating income is all the property's annual income minus all the property's annual expenses, except for the mortgage payment, the principal and interest. That's not included. We're going to go ahead and divide that net operating income number, call it $8,000 annually, divided by a property that you bought for $100,000. That's an 8% cap rate. Now, if you overpay for a property, it's going to be reflected in a lower cap rate. Because if you had that $8,000 net operating income and you paid $110,000 for it, well, now your cap rate is down to 7.3% rather than 8%. Did you ever see a listing for a rental property for sale and it quotes the cap rate, but it doesn't quote the cash-on-cash return? Well, why would that be? Well, that's because cap rate does not include financing on a property. You see, when that property is listed, the selling agent doesn't know what financing program the pool of potential buyers is going to use, or if they're even going to use financing at all. So a mortgage payment is not included in figuring out a cap rate, but yet cap rate is one of the most important investor metrics out there. Cap rate does include all the other expenses, even property taxes and property insurance. Those things are included in cap rate. Now, if you think like I first thought about cap rate, then right now you're like, why would such an important measure of a property's investor performance not even include my biggest expense, the mortgage? That's just kind of dumb. Well, cap rate is a measure of the building's performance. If an investor has a low credit score or inadequate reserves or some reason that they have to pay a higher interest rate for the loan, that lowers your investment's performance, but that's not the building's fault. Your credit blemish has nothing to do with the operations of the building. Remember, the cap rate determination is the net operating income divided by the property price or the property value. You can see a cap rate for a property advertised, but not the cash-on-cash return. I've found that a lot of students forget that cap rate excludes the monthly mortgage. They find that easy to forget. One way that I've helped students understand cap rates sooner is when I tell them this. A building doesn't have a mortgage, you do. You're the one that brought a mortgage to this property. This property didn't have a mortgage attached to it until you came along and brought it with you. That's your loan based on your creditworthiness, your credit blemishes, the amount that you put in as a down payment. Now, note that if you pay all cash for a property and don't have any mortgage, then your cash-on-cash return and cap rate will be exactly the same. So just to kind of review that, cash-on-cash returns are calculated with the financing cost included as an expense. Cap rates are not calculated with the financing cost included as an expense. Don't get concerned if you forget the difference between cash-on-cash return and cap rate. Once you get the swing of using them, you'll never forget. If you're only going to focus on learning one of them first, make it cash-on-cash return, because that's the actual return on your money and what really matters in the investing world. So there is some technical math involved with those above terms, and real estate investing is partly a numbers game. But if you haven't heard, here's the good news about real estate math. It's all just addition, subtraction, multiplication, and division. Yeah, that's it. I own several $1 million worth of real estate in multiple states and multiple countries, and I've never had to use any math operations like exponents or square roots, logarithms, or any trigonometry or calculus. So the math is easy. It just takes a little practice to know which calculation to use. You might use cap rate in a sentence as, I'm looking for good returns, so I need to find a high cap rate market. Now, I know I went a little out of order alphabetically above, but I wanted to do those other terms first because they're easier to understand than cap rate. So the next term is commercial loan. Commercial loan trips up beginning investors because it's not as it sounds. A commercial loan is a financing instrument used for retail centers, office complexes, and hotels. Yes, it is, but the confusion stems because a commercial loan is also used for residential apartments when that apartment building contains 5 or more units. In those cases, it's a commercial loan for residential property. A residential loan is for a property of 1 to 4 residential units. Those would be for single-family homes, duplexes, triplexes, and fourplexes. Well, the difference is more than just name semantics. A commercial loan uses different underwriting standards than a residential loan. That means you qualify for it differently. In general, a residential loan for 1 to 4 unit properties looks more at the borrower's creditworthiness, your FICO credit score, your personal debt to income ratio. Qualification gets kind of invasive, It's like they want to know the age of your pet and whether you feed your pet regularly before they'll even accept your application. It's almost over the top, but it's worth it. Well, with a commercial loan, again, 5 or more residential units, qualification is actually simpler. Why? Well, that's because you start dealing with properties so large that it hardly matters what your income and debt is. You need the property to perform well to pay the mortgage note. So that's why with a commercial loan, they're actually easier to qualify for as long as you have a good building where the cap rate is going to exceed the mortgage interest rate with enough of a cushion. That's what lender is looking at. Last year, I bought 2 larger commercial apartment buildings without any partners. It was just me buying those. So I was very aware of what the lender was looking for, and the bank only made sure that my desired buildings met 2 criteria. One is that it was a profitable building, and the second one, well, it was kind of me, but they were only making sure that I had a 20% down payment for each building. That's it. Number 1, do I have a profitable building? Number 2, do I have the 20% down payment? That's all commercial loan underwriting look like. You do typically pay a higher interest rate for a commercial loan of 5 or more units than you do for a residential loan of smaller properties of 1 to 4 units. There are a lot of advantages of commercial loans over residential loans, but that's a topic for another day. The next term is dividend. Dividend sort of relates more to stocks than real estate. It's a sum of money that a company pays regularly to shareholders out of their profits. It pays out monthly or usually quarterly. Some stocks pay you a dividend for holding them, some don't. Typically, those stocks that do pay dividends tend to be those older, more established companies that have accumulated more cash so they can pay that out to their shareholders in the form of a dividend. Those might be companies like General Electric or Caterpillar. Those companies that don't pay you dividends, they don't have as much cash because they're reinvesting it into new technology. Think about fresher, more cutting-edge companies that can't afford to pay a dividend like Tesla, Twitter, or a hotshot 3D printing stock like Stratasys. These newer companies are investing their cash into new research and development. They're not focused on paying cash to you, the shareholder, because shareholders expect more capital growth, more share price growth in such a young company. A stock dividend paid to you is sort of like cash flow is for real estate, and it is making money follow you, but the average dividend yield of the S&P 500 is 2% per year. Yeah, 2%. That dividend yield percentage would correspond roughly to a 2% cash-on-cash return in real estate. And if your real estate cash-on-cash return were as low as 2%, I'd say consider not buying that property because the profit margin looks pretty thin. Why bother? Move on. Now, you might use the word dividend in a sentence like, that stock doesn't appreciate much, but at least it's paying me a dividend. Equity is the next term. Real estate equity. That's the difference between the amount owned and the amount owed. If you have a $200,000 home and you owe $160,000 on the loan, your equity is $40,000 or 20%. See episode 6. That entire episode was about property equity and how everyone you know is mismanaging it, and they're postponing or jeopardizing ever becoming financially free because of it. Used in a sentence, you might say, did you know that the rate of return on equity is 0? And you'll know what I'm talking about when you hear episode 6. The next term is FICO Score. FICO. FIC and O are all in capital letters. Your FICO score, that's defined as what I'd call the best credit score indicator. And a credit score is a number assigned to a person that indicates to lenders their capacity to repay a loan. It measures a person's creditworthiness. FICO stands for Fair Isaac Corporation. Not all credit scores are created equal, and a FICO score is the one that most mortgage lenders use. Other companies have popped up that have their own proprietary scores, but many of them don't mean much. It's just kind of entertainment for the user. FICO scores range from 300 up to 850. That's the score you want to focus on if you're positioning yourself to qualify for a mortgage loan. There are 3 major credit reporting agencies, Equifax, Experian, and TransUnion. All 3 of them have FICO scores, so you'll have 3 FICO scores. You can go to myfico.com to check that out and learn what ingredients make a good FICO score. The next term, inflation. That's defined as an increase in prices and a decline in purchasing power of the dollar, or whatever currency your country uses. For example, if you bought a stock last year for $100 and inflation was 3% over the last year, you need to sell that stock for $103 just to break even. People like to sound like they're successful investors, and I guess I do too, and they'll want to say that they made a small gain in that case, but they didn't. I typically ask myself the question, what is my gain on an inflation-adjusted basis? A financial return above and beyond the rate of inflation is what creates a real increase in purchasing power for you. That's what increases your prosperity. It's not just the amount of what you've got is denominated in dollars. Something that is pretty easy for you to say and understand, but shows that you're thinking and that you get this is you're asking about an investment and you simply say, I look at how my investments perform on an inflation-adjusted basis. Whew. I mean, dude, you dropped that. You just dropped some investor vocab dynamite onto some unsuspecting civilians that had no cover. I mean, I don't even know if they're going to be able to recover from that. All right, the next one, intelligence. Let's look that definition up. Oh, look at this. Right next to intelligence, it says anyone that agrees with Keith Weinhold. That wasn't funny? You're not going to laugh? Not even a little chuckle, a titter? All right, moving along here, interest is the next term. That's defined as the price paid for the use of borrowed money. An interest rate is the rate that's charged or paid for the use of the borrowed money. In a sentence, it might be, what kind of mortgage interest rate can I qualify for with a 20% down payment? Okay, so your interest rate is the cost of your money. The next term is K. And just simply a capital letter K, that's defined as $1,000. I favor using this term over grand. If you're describing $10,000, say 10K rather than 10 grand. 10 grand sounds unsophisticated. It makes one sound more amateurish and smallish. Maybe like they're thinking $1,000 is something so grand to that person. Well, in real estate and in the investing world, that doesn't buy much or get you much. So try to get used to using K, even if you kind of feel like you're playing out of your league a little bit. For example, you might say, I'm transferring 30K of equity out of this property. All right, the next term, liquid or liquidity, that's defined as the condition that an asset can quickly be converted to cash. If you can quickly get into an investment and sell out of an investment, then it's likely highly liquid. For example, if you need cash, you can convert the stocks in your E-Trade or Scottrade account to cash pretty fast. Log into your account and sell it when the market opens and your brokerage sends you a wire or a check in just days. It's highly liquid. Real estate has created more millionaires and billionaires from ordinary people than anything else, but it's not liquid. If I want to sell an apartment building today, I cannot do it. It might take 2 months from the time that the property is listed for sale and marketed, has its various buyer offers and counteroffers, due diligence, which is research, executed by the buyer, inspection, reinspection, and lender appraisal. The investment is not very liquid. So don't put a $20K down payment into investment real estate if you need that $20K back in a few months. I sort of joke to my investor friends that once someone becomes a full-fledged investor, no one says that they've run out of money. They don't want to say they don't have any money to invest right now. They start saying things like, before I'm ready to invest again, I need to position my portfolio for better liquidity. So you can ask a good question while you're learning about an investment by simply asking, what is my investment's liquidity? And you'll find out how quickly you can receive your initial investment back. The next term is 2 words, superhero syndrome. That condition refers to the person that says, I'm going to do it all myself. Yes, I made up the term superhero syndrome. I mean, how scalable are you going to be able to make your business, or how big are you going to be able to make the size of your income property portfolio if you're the one collecting the rent, doing the accounting, shoveling the snow, cleaning the gutters, tailoring your lease agreements? I mean, you aren't going to go very far. Don't try to do it all, except for maybe in the very beginning to get a general understanding. When you learn how to be an effective investor, you can farm those tasks out and still be a profiteer. So just remember, regularly ask, what's my return on time? How is this advancing my quality of life? Some people that know that I'm a real estate investor think I must know a lot about building construction, for example. I don't. I know of some great building inspectors that I hire to look over a building before I buy it. I can't build anything. If I had to build a simple little lawnmower shack, I would have no idea of what to do. Even if I managed to build one by using YouTube videos, that shed would blow over with the first 10-mile-an-hour gust of winds. I mean, flattened. All right, that's all we're going to do for vocab rehab terms today. We didn't even do some of my favorites yet. Down the road, we'll do some more terminology. Investopedia.com is a good source for definitions of investor words. Now, I've got something for you to think about and chew on a while. This is sort of advanced. Here you go. In real estate investing, your cap rate minus your interest rate is your arbitrage. Yeah, cap rate minus interest rate equals arbitrage. If that's new to you or you need time to get your head around that, I would expect it. But we've defined all 3 of those terms above. Most intermediate and many advanced real estate investors don't even know that. This is a kind of episode that you might listen to a few times to assist in understanding. You sell yourself every day. Education pays. You heard that growing up, and it is true. Education pays. Well, unfortunately, usually education doesn't pay well because people are studying the wrong things. Here's why today's episode is important. Most people study how work works. They don't understand how money works, Yet money is the main reason that people go to work. So you owe it to yourself to learn how money works. As one of my missions is to make you more successful than me, faster than me, motivating you to brush up on some vocabulary is a good accelerator for you. If you get used to using investor words and start putting them into practice, your friends are soon going to notice that you've quickly done a rip, pivot, and jam to betterment, and some are going to want to come along with you. All right, I hope that you have a great holiday season. One last holiday investor thought, though. I recently got the monthly statement from my property manager in a market where I have 20 rental units, and I noticed that the income was unusually small. I looked more closely at the statement, and I did an email reply to my manager's accountant as to why I only received 15 of the 20 rent payments. Well, it turns out that 5 families are paying late, and I've never had as many as 5 pay late there. The accountant suspected that it was due to Black Friday holiday shopping, so maybe some of my tenants are living it up better than me this holiday. I don't know. That manager always collects the rent for me, even when some of them come in late. Merry Christmas or Happy Holidays with whatever you choose to celebrate this holiday season. Use this extra holiday time off with family and friends to get inspired, learn from Get Rich Education, and tell them about Get Rich Education, and be more likely than ever to go out and don't quit your daydream.
You've been listening to the Get Rich Education podcast, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.